In this week's video, we'll see what we can learn from an extremely rare stock versus bond setup, and we'll also check in on physical gold. The facts that we're about to review will help us address two major questions this week. Question number one, have balanced stock bond portfolios had their day in the sun? Question number two, is gold in the early stages of a long period of underperformance? In last week's video, we covered numerous risk-on, risk-off ratios, including large cap growth stocks relative to bonds, or in more simplified terms, stocks versus bonds. These two charts appeared in the November 21st CCM weekly video, and we presented them as part of the weight of the evidence, understanding that those risk-on, risk-off ratios should look a certain way if they're going to support the bullish evidence that we've covered in these weekly videos over the past 18 months. We'll take a similar approach this week, however, we'll extend our time frames out considerably. This is a very long-term daily stock versus bond chart dating back to 1978. This is the ratio of the S&P 500 index relative to a 30-year Treasury bond. Like many of the charts that we've covered in the past 18 months, we have a very long period of consolidation here with the ratio entering the lower end of the box in 1994. It was rejected at the top end of the box in 2000. And we know after this, bad things happened in the stock market. The ratio was again rejected before even reaching the top of the box in 2007. And we know really bad things happened after this point here. It went down to the bottom of the box in 2009, the exact same level that it visited way back in 1994. We made a run at the top of the box in 2014, and it looked like we were failing in 2016, meaning this point here looks similar to this point here and this point here. But that proved to be a false breakdown, and now we've rallied in the other direction, and we have a bullish breakout on the daily chart. We've now exceeded this level, and this level, all three levels that rejected price in the past. Price first entered the bottom of the box in 1994, and it exited the box recently. That's 23 years that price was consolidating inside of this orange box. If we focus in on the top of the box only, we can see during this 7-year period here in the 80s and early 1990s, the ratio consolidated inside of this orange box for 7 years. We've consolidated inside of a similar box, only using the top of the box, for 18 years in the present day. And we know the longer a market goes sideways, the bigger the move that we can expect to get when we either get a bullish breakout or bearish breakdown. After this 7-year period of consolidation here, we had a bullish breakout telling us if this bullish breakout holds, we should be open to much better than expected outcomes in the stock bond ratio relative to what we've seen over the past 18 years. Said another way, the next 18 years in the stock bond ratio may look significantly different than what we've grown accustomed to over the past 18 years. Now we're looking at the same ratio, S&P 500 relative to a 30-year Treasury bond. Now we're looking at a quarterly chart, and we can see the same period of long-term consolidation with a bullish breakout taking place in the present day. This chart is dated November 23rd, 2017. If you watch our weekly videos on a regular basis, you may remember that we've used ADX. ADX can help us with the strength and direction of a trend. The single best signal with ADX comes after black falls below both red and green. In the present day, in 2016, black was below both red and green. When black rallies from below both red and green, It shows the market is waking up from a lull. Here we have a strong bullish trend. Down here we have somewhat of a trendless market. And we really don't need ADX to tell us that. We can look at the ratio here and see that we've had a trendless, long-term consolidation type market dating back to the mid-1990s on the quarterly chart. So right now, ADX falls into the single best signal category when black is now starting to rally from below both green and red. And what this tells us is we may be at the early stages of a very long-term trend. And in this case, the bias says that it would move from the lower left-hand corner to the upper right-hand corner, and it would be a favorable trend for stocks and an unfavorable trend for bonds relative to stocks. It doesn't mean bonds will get killed. It just means during these type of periods, stocks are a much better place to be. In a very, very similar manner to the expression, the longer a breakout holds, the more meaningful it becomes. If ADX can climb from the low on a quarterly basis in 2016 of 12.86, if it can make it to 16.86, our confidence would increase that this breakout will hold and the ratio will have a high probability of moving in this direction and exceeding expectations for possibly years to come. All of that is to be determined. Right now, we are making probabilistic statements based on facts that we can see, measure, and put in a model. If the facts change or the breakout fails, then our assessment of the longer-term probabilities will be changed as well. When chess champions around the globe are interviewed, one common thread that always seems to emerge is that they study setups on the chessboard. They don't necessarily get better by playing chess over and over and over again. And we don't necessarily get better in the stock market by trading. We typically get better by studying and understanding setups and patterns. One of the great things about yearly charts and using multiple time frames as the model does, it makes it much, much easier to recognize patterns in the big picture. When we look at this chart at Shavaco Capital Management, the first thing that jumps off the page is this quote: "A move followed by a sideways range. A move followed by a sideways range often precedes another move of almost equal extent in the same direction as the original move. A move followed by a sideways range often precedes another move of almost equal extent," which basically says we could cut and paste this move here from 1979, where stocks clearly outperformed bonds. You could cut this off the page, paste it over here, and we would have a move of almost equal extent in the same direction as the original move. The longer this breakout holds here, the more relevant this quote becomes. And it tells us that if you are relying on a balanced portfolio with 60% stocks and 40% bonds, you could be very, very, very disappointed in the performance of that balanced portfolio over the next 20 years. Once again, we're not forecasting here. We're making a probabilistic statement based on facts. These are facts. There's no argument about what we're looking at here. We're looking at a move followed by a sideways range, and now we have what appears to be a bullish breakout. As always, we'll take it day by day. As long as the charts look like this, we'll continue with the same probabilistic outlook. Another major takeaway here is this period here looks nothing like anything that happened between 1979 and the late 1990s. And even after these short periods of consolidation, we move, market needs to consolidate its gains. Market needs to consolidate its gains. Market needs to consolidate its gains. Big gains need to consolidate, gain, consolidate, gain. Fractals tell us this is the exact same concept as these smaller boxes. It's just on a much larger time frame. And much like these periods here, after the period of consolidation, we would expect if this breakout holds, the market made a big move, consolidated its gains, and now it's probably ready to make another big move. Like any bullish breakout, these breakouts that we're covering could fail, and that's where maximum flexibility comes in. If they fail, we will still learn something as long as we're flexible enough and we can push our ego aside and acknowledge the change in the setup. Similar situation here. Last week, we covered stocks relative to gold on a shorter term time horizon. This is 2007, 2008. This is 2016, 2017. And we said the look of these charts aligned perfectly with the mountain of bullish developments that we've covered in these weekly videos over the past 18 months or so. So if we take a big step back with the stock-gold ratio, does it support the weight of the evidence or does it contradict the evidence we've covered in past videos? This is a quarterly ratio chart of stocks relative to physical gold. Calendar year 1979 on the left side of your screen. The present day, November 22nd, in this case 2017, on the right side of your screen. Once again, with pattern recognition, the first thing that jumps off the page, we're coming out of a long-term period of underperformance by stocks relative to gold. The first step for a trend change, keep things simple. We have to break a downward sloping trend line. We did that here. Step 2 for a probabilistic trend change, we have to make a higher low relative to the previous low. We did that here. And in order for this to morph into something like this, we know eventually we have to make a higher high. And on this quarterly chart, we're doing that right now in the present day. The longer the breakout holds, the more relevant it becomes. We would classify this ratio as a it's nice to look at from time to time ratio. This is not a core input for the CCM market model. And if this breakout were to fail, it really wouldn't be all that big a deal because we would continue to track the evidence. But right now, this aligns with a similar situation that we might be getting a very long-term period of outperformance by stocks relative to gold. Just as the present-day setups tell us that we may be in the early stages of a very long-term period of outperformance by stocks relative to bonds. All of this speaks to improving animal spirits for stocks relative to more defensive-oriented assets. And all of the charts that we've covered in this week's video support the bullish case rather than contradict it. Is there anything else that we can look at from a fact-based perspective? Yes, if we add in MACD that helps us with momentum for this same ratio, we can see back in 1979, MACD was below the zero line here. And this is a bullish shift here that we can see, measure, and put in a model in the late 1980s where we cross above the zero line. And here in the early 1990s, we have black above red, and we've clearly moved above the zero line, and it appears like we're going to stay there. After all three forms of observable evidence, stocks outperformed gold significantly for the next 8 years. If we fast forward to the present day, MACD was below zero, was below zero. Then we recaptured the zero line. We recaptured the zero line. Here it appears that we're going to stay above the zero line. Here it appears that we're going to stay above the zero line. The setup that we have with MACD here is very, very similar to the setup that we had here in calendar year 1991. We also know that MACD gets bullish and bearish moving average crossovers. This is a bearish crossover here where black drops below red. After we could see this, measure it, and put it in a model, really bad things happened in the ratio for a very long period of time. Conversely, all things being equal, when the lines are kissing each other as they were here, and then we get a bullish cross, that's a good thing. Here we get somewhat of a whipsaw look. This is our nimble barge look here, where we get a momentum shift that looks bearish, and then we flip the other way. As we know, we often get big moves in the other direction when something like that happens. We get the bullish cross here. Good things happen for a long period of time. Bullish cross here, and in the present day, we still have a bullish cross, telling us to keep an open mind about better than expected outcomes in this ratio for several years. How about silly rabbit? Tricks are for kids. If we look at Tricks, which uses triple smoothing, and Tricks is designed to filter out insignificant price movements. Chartists can use Tricks to generate signals similar to MACD. 1984, we get a bullish cross here. After that, good things happen for a long period of time in the ratio. Here, we get a bearish cross. After that, bad things happen for a long period of time in the ratio. Here, much like this period here, we have a bullish cross followed by a recapture of the zero line. Here, bullish cross, we recaptured the zero line. Once again, telling us to keep an open mind about better than expected outcomes in the stock gold ratio for a very long period of time. We're not forecasting anything here. We're making probabilistic statements based on what we can see. If the facts in front of us change, then our assessment of the facts will change, and that's where the flexibility comes into play. From this bullish cross here to the peak in the ratio here, the ratio had a good run for 16 years. In the present day, we're about 5 years into this move here. So if we double back to our original questions, given the facts that we have in front of us, what we know today, from a probability perspective, the answer to this question right now is yes, it appears that way. And if you have a big exposure to bonds, you might be greatly disappointed in your performance looking out 10 to 20 years. And since gold underperformed for 16 years after we could see this, measure it, and put it in a model, the answer to this question, based on the facts that we have in hand, is most likely yes. And we'll continue to take it day by day. No forecasting, just probabilistic assessments based on facts. No opinions, no fear about what might happen. Just the facts. And as we've noted in recent videos, we are not using these long-term charts as timing charts. The charts that we've reviewed in this video are long-term, big picture, confirmation charts. The confirmation charts help us understand what the forest or big picture looks like. The trees help us monitor and manage risk on a real-time basis. These are the daily charts that we've covered in the past for illustrative purposes only. This is the 100-day moving average in blue here, and we go all the way out to the simple 290-day moving average. Is it possible that every single chart that we've covered ends up in whipsaw mode? We know the answer. It's absolutely, positively yes, that is possible. But if that happens, the tree charts or the shorter term time frames that are used as timing mechanisms in the model will reflect that flip. We could see all of this, measure it, and put it in a model before the S&P 500 lost an additional 46% after the dot-com bubble peaked. And we could see all of this. This looks radically different than this. We could see this, measure it, and put it in a model before many people experienced a life-changing and gut-wrenching 56% drawdown on their hard-earned investment capital. Therefore, in the present day, does the chart of the S&P 500 look anything like this or this? Or does it even look anything like this or this? Once again, the answer is absolutely positively no. These are the exact same moving averages as of 11:04 a.m. on Black Friday, November 24th, 2017. And we can see that the evidence that we have in hand looks nothing like this, nor does it look anything like this. And as we've been noting in these videos for several months, keep it simple. This chart continues to look like a long-term and sustainable bullish trend. What does sustainable mean? It means when we experience a normal and 100% to be expected pullback, or normal and 100% to be expected volatility with a look like this, the probabilities say the odds are very, very good that will be followed eventually by a new all-time high. In this instance, the market gained an additional 156% after this point here, and in this instance, we gained an additional 26%. And as always, if we want to focus on the longer-term probabilities and longer-term trends, it's extremely important that, number one, we don't try to catch all the fluctuations, and number two, we avoid these common missteps. Our goal is not to avoid volatility. Volatility is a normal part of all trends, and if we're going to try to capture a multiple year move from a point A to point B, and this is a 952% move in a major index, we didn't have to own any fancy ETF. We could have owned a technology index and captured a gain like this. And in the present day, what's going to happen tomorrow? We really have to answer that in this way. We have absolutely, positively no idea. With that attitude, we can be open to all outcomes, even worse than expected outcomes, and that maximum flexibility will allow us to adjust our probabilistic outlook in our portfolios as needed. Track all of this and convert it into a usable and actionable format in a reasonable amount of time. The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shervacco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.